What's up, traders? My name is Timothy Hellberg. I'm a professional trader since 12 years back, having had a career in different trading firms around Northern Europe, both professionally and running my own services, my own accounts, my own managed accounts, etc. Nowadays, I mainly work with educating new traders as well as running my own firms where I do proprietary trading, working with some selected investors and doing algo producing. But today I'm bringing you a market report in collaboration with IMGFX, the people's broker for week 25. So before we jump right into it, let me just remind you that this is not a recommendation to buy or sell anything. This is just my view on the markets for the upcoming week, and we're going to talk a little bit about some trades that I see as a possibility and my outlook for some certain currency pairs, as well as Bitcoin, etc. But you should always do your own research and trade on your own instinct, basically. So, the agenda for today will be that we'll start out by talking about the economical calendar, where we talk about the events for next week. Then we'll talk about market sentiment, the current and the potential shifts to look for. We won't talk about last week's calls in this one, as we didn't have a market report last week, as I was moving and my office wasn't in order yet. We'll talk about Bitcoin, where we might have a bloodbath down to 12k. We'll talk about gold, where longs off support has been the go-to trade. And then we'll finish up by talking about EURJPY, where we might have a trade that is a possibility to timing by selling the top. And we'll talk about dollar CAD, where we have a fair value breakout coming. So, starting with the economical calendar. If we take a look at Forex Factory, you will see that Monday is a pretty slow day. We have a bank holiday in the United States, so not much is happening there. Tuesday, we got some Australian news and some CAD news, but nothing major at all. Wednesday, we have CPI year on year for the pound, which can move the pound a little bit, and we also have CPI for the CAD later that can also move the CAD. So if you have exposure in those pairs, you better keep an eye out for them, as they are good inflationary readings. And as I've mentioned in many of these reports by this point, it's all about inflation in the world right now. Later in the day, during Wednesday, we have Fed Chair Powell testifying to Congress, which of course will be usually those testimonies can be a little bit not market moving, but with the focus of the markets on inflation and the focus on what is the priority of the Fed. Is it the stock market? Is it the inflation? What are the markets supposed to price in? That is something that testimony will give some indications on. So definitely worth keeping an eye out on that, because if you don't, you might see a big pop in the dollar in either direction all of a sudden that you didn't really expect. Thursday, we have the German flash PMI, which of course can move the euro. I wouldn't expect too much fireworks there. We have the second day of Chair Powell testifying. And then we end off on Friday with a bank holiday in New Zealand and a Governor Lowe talking for the Australian dollar, which I wouldn't expect too much from. So, with that said, let's jump into the charts, and when doing so, we like to first let's take a look at market sentiment. So what we always do there is firstly take a look at the VIX, which is the volatility index measured in S&P 500, the 500 largest companies in the US. So if we take a look at that, you can see that we are still in slightly elevated levels. We are above 30, which is considered slightly elevated volatility. If we take a look actually at the S&P chart, you will see that this breakdown that I highlighted several market updates ago is really closing in on the lower bounds of what I projected. It took a little bit longer than I was expecting, but we are getting to those low points. But the market sentiment, we saw it sour a little bit at the end of last week, but now what's happening, guys, is that we are coming into the end of June, and the end of June is not just a month end, it's also a quarter end. And in quarter ends you have all the big guys, so hedge funds, investment banks, etc. They are going to have to balance their portfolios, meaning that they will have to close out trades, etc. They will do anything they can to make the quarterly numbers look as good as possible. So you will see a lot of restructuring, a lot of repositioning in the markets due to the quarter end. If you remember all of these yellow boxes, I highlighted that when on the weekly chart, when the S&P broke the 100-week moving average, it generally moved down into the 200 weekly moving average shortly after, and that's what we're targeting in the latest. But if we go far back here, if we take a look at back the last bear market that we had in the S&P. So we are entering a bear market now. The last bear market that we had was back in 2008, the financial crisis. What we had then, what I've highlighted here on the chart for you guys, is we had a cycle of 2 months bullish retracement inside the bear market, 2 months bearish, 2 months bullish, 2 months bearish, 2 months bullish, 2 months bearish, etc., etc. So am I saying that S&P will move in the same way now? No, that's not my point here. That 2 month structure is not what I'm trying to highlight here. What I'm trying to highlight here is that what I'm expecting heading into this quarter end is that we will see the S&P going into one of these bear market corrections. So I'm expecting risk to actually to be a little bit more positive into the last 2 weeks of the month, and I'm expecting the S&P to move up a little bit. I'm expecting risk to be a little bit more positive, and I'm expecting the US dollar to hence pull back a little bit. So if you take a look at the US dollar index, we are actually at a point where that could make some sense. So if we jump to the latest, you can see that we are extremely overbought on the daily chart, and adding to that we have this bearish divergence setting in on the daily chart, where we pulled off pretty hard off to the downside. So we still got a lot of room to go down to the 100-day moving average. So I think there's a lot in the charts, adding with the seasonality and how stocks generally work and quarter ends, etc., telling us that we might see a bear market rally into the last weeks of the month. And today we're going to structure the trades that we're looking for in combination with that. So, talking about trades, if we start out by looking at BTC, so Bitcoin against the US dollar, we are on the daily chart. As you know, we traded in this sort of channel right here, and we broke out of it to the downside, and we have moved much lower since. So, having done that, about 3 times before has the BTC been in a actual bear market. In all of those 3 times, BTC corrected more or just about around 85% of its value. We are currently sitting at around 73%. Adding to that, we also are closing the week below the 200 weekly moving average, which comes in around 23,000, which is up here. So we are definitely closing below that for the week, unless we get a big pop into late Sunday evening. But and anytime that has happened, it has pretty much always respected its 200 weekly moving average. So expect this to a lot of that is telling us that there's still room for Bitcoin to move to the downside. If Bitcoin is going to correct around 85% as it has done before, that means that we would target the 11/12K value, which is obviously a fair bit down to the downside. I'm not saying that we're going to get that. Bitcoin is a little bit weird in that sense, but we might. So I'm not going to trade Bitcoin at this point in time, but if you are, I would definitely think that this short trade is the trade to go for here, and targeting that 12K level down here. That would definitely be my guess and my take on it. Next up, gold. As you know, with the gold, I've talked about a lot about this over the weeks, over the months, that when we have inflationary pressures like we have right now around the world, gold generally does well. We've had 2 support zones lately that we've been working with in gold. We've had this yellow here and we've had this red. Buying off these zones have been very fruitful and been working very, very well, because you have to remember that the technical chart only tells you the short term. The general picture of the outlook is still unchanged due to, in terms of the macro environment hasn't changed. There's still inflationary pressures. Now, gold is still valued in US dollars, so it's not that easy just saying that, you know, gold will move up, but there's a lot talking for gold to get going, especially in this month. So what we specifically are talking about here is that we have the chart where we have these 2 support zones that have been working very, very well. We also have a bullish divergence that have been setting in, and we rebounded pretty hard off it on the daily chart. Adding to that, we have the US dollar correlation, where I just showed you the US dollar chart, where there is room for the US dollar to fall, which would bring the value of gold up. But we also have seasonality. Seasonality is how currencies and commodities behave year in, year out, and there's different ways to compound that kind of data. And gold as a commodity, the value of that is driven by other things than just pure price action. It's actually driven by physical demand also. So if we look at the seasonalities for gold, we have that gold generally falls. So we're talking generally speaking, based on the last 54 years of data, gold generally falls from end of February into June. And that's because the world demand, the physical demand for gold during that period of time slows, it gets lower. Additionally, then what we have over these 54 years of data is that prices generally rise from July into early October, and then we stagnate for a bit and sometimes even pull back, and then again we get another rally from mid-December into February. And why is that? Well, there's many factors. So gold is often given as gifts during different celebrations and festivals. So a estimate is that up to 2/3 of gold's annual production is actually spent on jewelry. So obviously, if the demand for jewelry goes up, then the demand for gold goes up. So during this seasonality period that we are heading into now, we have year end, we have Christmas in all of the Western world. Then we also have the Chinese New Year in February, where it's big to give away gold. And then we also have the wedding season in India that occurs in the fall. So if you add all of these 3 things together, you have these huge economies: China, India, the Western world. So all of these huge cultural civilizations where the demand for gold increases. And we are heading into that period right now. So I personally am going to start structuring a lot of long trades in gold into the upcoming months. And I'm going to work that of this chart that you're seeing here. I'm going to work that of these 2 support levels to begin with. If we start moving lower, then we have to start looking for new support levels to work off. But there's a lot to talk for higher gold prices in the upcoming, and especially if you wanna buy and hold. So that's a big one for me. Next up, Euro Yen. If we take a look at Euro Yen. Euro Yen has a equity correlation. So if we take a look, you see this is the chart of, let me just reset the chart. This is the chart, the daily chart of Euro Yen. If we jump right over to the S&P, and I'm going to just flip between these 2 charts, you see that they are inverted. So Euro Yen moves a little bit like the S&P but inverted. So when the S&P goes down, Euro Yen goes up, and vice versa. So there's a correlation there. That correlation comes from Euro Yen being a funding currency, the euro, versus a safe haven currency, the yen. So that's the perfect kind of equity exposure. Euro pound is a little bit better for equity exposure, but euro yen is good when it comes to actually risk sentiment exposure too. And what we didn't have in the economical calendar earlier is that the Bank of Japan, they are starting to buy bonds in the upcoming week. So the Central Bank of Japan, they are starting to buy bonds. They're doing this to keep a cap on the 10-year yield. That's negative for the Japanese yen. To some extent, that's already priced in, and that's mainly the options market that prices that in. But it will still affect the real money flows, and the real money flows will affect the actual value of the currency, which will affect the currency pair that we are trading. So, with that said, when we have the correlation to equities and we are expecting equities to pull back, right? We're expecting the S&P to enter a bull market, not a bull market, but a bear market rally, a bear market pullback. So we're expecting the S&P to move up. That means that we are expecting euro yen to move down. So add to that the Bank of Japan are going to operate in the currency market in the upcoming weeks in a way that is also weakening the yen. Now, all of the macros are in line for the yen pretty much becoming weaker. But if we look at how much is priced in terms of what the Bank of Japan is doing, my guess is that this price action that we have seen here with the yen weakening so aggressively against the euro, that's the pricing in of the operations of the Bank of Japan. So that leaves us with just the equity correlation, which leaves us with a short trade, as we are expecting equities to go up, we are expecting euro yen to go down. And with where this currency pair is at this point in time, I would expect this to be a good trade setup, as you have a potential to try and actually short it of the highs. You're trying to pick a high. Doing that, now we'll have to see how price action behaves in the beginning of the week. Now obviously you can have a stop up here, but preferably, I want to see how the market opens on late Sunday evening and get a tighter stop than all the way up there, and then pretty much just target the 100-day moving average, because I mean, depending on where you can get your stop loss, as you can see, that trade right there is a 6 times risk reward, which is a great trade to take. That's a risk that I'm willing to take for my account. So, looking for a short on euro yen. Market open will really tell us where we want that stop placement. Dollar CAD is the next trade that I want to look at. So with dollar CAD, we have something called fair value. Fair value, I've talked about a little bit before, and that fair value is something that you have in currency pairs where you have a big exposure to a physical commodity. CAD is obviously a lot of exposure to oil, and when you have that, you get these big consolidations, especially on the higher time frames, and that's because the price of the commodity doesn't want to fluctuate too much. So if we take a look at the oil chart, the oil chart, we have moved out, and now we're starting to pull back. We were overbought, we're pulling back, we're heading into the moving averages, and we could see a potential of this bouncing of the moving average and move higher again. If we get that, then heading back into dollar CAD, that could really be a case for dollar CAD breaking out. So we have two ways to trade this. My preferred way would be in line with what we have already talking about. So a weaker dollar, which means the dollar down, a stronger oil, meaning a stronger CAD, meaning dollar CAD down. That would also fall in line nicely with this consolidation that we've had. So then we could easily just trade against these tops, view this as a double top, and trade it to the downside of this consolidation pattern. But we could also see oil prices pull back, and if we do that, then instead we have a fair value breakout, meaning we are breaking out of this consolidation, and price will try to look for a new area of consolidation where it's happy with the latest value basically. And if you, as you can see here lately, when you have these commodity currencies, when you get a breakout out of that consolidation, they usually go for quite some time before they find that long-term consolidation. Same goes back here. You get these big trends. Now they can be of course a little bit choppy, but if you really are a long-term swing trader, those kind of trends is really something that you want to run. So I hope that made sense. Dollar CAD, two ways to trade it, really depends on the oil price, but my preferred trade is to the downside. Euro yen, looking to sell the top, I think that's good. Gold, based on seasonality and the macro picture, it's a good time to start building up those long trades. And Bitcoin, not touching it at this point, but we are in a scenario where we might see 12K on the chart. So hope that made a lot of sense to you guys. If you wonder anything, just leave a comment, hit the like button, would be greatly appreciated. If you want to connect with me, feel free to do so on any social, LinkedIn preferably, and we can get chatting about the markets, etc. So yeah, just Google my name. That's it for this time. My name is Timothy Hellberg. Hope you have a good and profitable week. Stay safe, guys.